Let's now discuss a little bit about dividend investing strategies, which seem to be very appealing for retail investors. And let me tell you that in 2019, the Bucharest Stock Exchange market was offering the highest dividend yield in the world. We had many public monopolies, and therefore retail investors are very attracted of these companies because they say they offer me passive income. So you have mentioned in a recent podcast that dividends are not income, that they are a return of capital, not a return on capital. Can you make beginners understand why dividends are not income? And after all, which is your definition for passive income?
Right. So income is, let me say it this way. Dividends are not income except for income tax purposes, at least in the U.S. The company earned income, that's its earnings per share, and it paid taxes on that already. And now it's giving you back that earnings by paying out a dividend. It's just returning the capital to you. It's not income to you. And it's simple to understand the concept this way. Let's say you gave a company, to keep it simple, $100, and that was its capital. And you bought one share of the stock and it traded at $100. Now the company earns, and let's say the market traded that stock at 1 times its book value, right? So now you bought a stock, it's $100, and it earned $10 after taxes. And so now what should the stock price be? 110, right? Now it pays, let's take a company that does not pay a dividend. What's your value? It's 110. If you have income, income by definition increases your net worth, right? All right. So now you take that same company, but it now pays a dividend. The stock price, it pays that income out. It pays the dividend to you with $10. And what happens to the stock price? It goes to 100 because it only has $100 of capital. So you have $100 in cash, so $100 in stock, and $10 in dividends. In the first case, you had $110 in stock. Your value is the same. So how could dividend be income when your net worth didn't go up? It actually went down if you're in the U.S. because I had to pay taxes on that dividend. So I don't want the company to pay a dividend if it's in a taxable account. That's bad. It would be much better if the company used that cash to buy its stock back or do nothing. And if I need the cash, all right, I could sell $10 worth of my stock. I sell it, and now I pay taxes at the much lower, in the U.S. anyway, tax on long-term capital gains instead of ordinary income. Dividends are just returning that capital to you. And the stock price will go down by the amount of the dividend, and in theory, might go down even more because the company's leverage is increased. It's more risky because it has less cash on its balance sheet. So that might be a problem too, if it does. And all a high dividend means is that the market thinks it's a very risky investment. Otherwise, the dividend yield would be lower. So dividends are just let me say it this way, a high dividend yield is nothing more than a very weak value metric. In other words, it's an indicator of something selling cheap, but the research shows you get a much bigger premium if you buy stocks with low prices to earnings, cash flow, sales, etc., rather than low prices to dividend.
Mm-hmm.
The premium has been literally, there's been no statistically significant premium from buying high dividend paying stocks. And I will tell you this, if you give me 1 second, I'll give you a little bit of data okay, here we come. So I looked at this just the last 3 years, just to make a point, because I get this question a lot. Let's see. No, it's not there. At any rate, the Vanguard High Yield Dividend Fund, which is the largest high dividend strategy in the world, so a lot of people believe in it. It has underperformed the S&P 500 for the last several years, and it's underperformed non-dividend paying stocks by wide margins the last several years. So that's a real problem for investors. There's no evidence or any logic to a high dividend strategy, and it's tax inefficient.
So you would have been better off to give you your own dividend by simply selling stock, because dividend is a synthetic concept after all.
That's right. By the way, there was a paper written back in the 1960s by Modigliani and Miller, and they said dividend policy is irrelevant, basically for the reason you said. You can create your own self-dividend, and that has never been refuted. And you would think with all the geniuses in finance, if something was wrong, and finance professors love nothing more than to prove somebody else wrong, that's how you get published, become famous, somebody would have figured that out in the last 60 years, and no one's even questioned it. And yet you hear this nonsense from people all the time about high dividend strategies and that it's income. Statman and Sheffrin, two of the most famous behavioralists, wrote a paper explaining why people lie to themselves about this, make up stories to, that help explain why they buy dividend stocks. And they're all just stories. But dividends do not protect you from bear markets. You get that dividend and the price drops again, whether you got it there or not. The value is the same, right? It makes no difference. The company has returned capital to you, whether it's in a bull market or a bear market. Doesn't matter.
What about dividend growth investing strategies? There are people who would like to buy companies which grow their dividends annually.
Yeah, that is a better strategy, but still not a good one, because all you're doing is buying quality companies. Okay, so there's a quality or profitability factor there. And that's been well identified. And companies that have the same characteristics of growing earnings, have strong balance sheets, don't use a lot of leverage, they have the same returns, whether they were growing their dividends or not. And what's important is today only about a third of companies pay dividends. So you're eliminating 2/3 of all the stocks, which makes no sense. You're not diversified enough. So it's not a bad strategy because you're getting at this quality factor, which is played out well. But why do you want to only own 1/3 of the stocks when you got the same returns and more efficiently? Because I'd rather own those same stocks without the dividend, because I'm getting a higher after-tax return.
Yeah. So you previously said that the more frequently we check the value of our portfolio, the worse our results are likely to be. What can we do to stop checking our portfolio so often?
That's a hard one. That's a behavioral problem. I would say go spend time with either your grandkids or your wife. Every time you're tempted to check the stock market, go do something else that's far more enjoyable and likely to add value and quality to your life, because the evidence actually shows, there are studies on this, the more often you check the value of your portfolio, the worse your returns are. And the reason is quite simple. There's only two things that can come out of your checking. You'll either do nothing or do something. And the evidence shows you're better off doing nothing than doing something. Most of the time you'll screw up unless you're just rebalancing. By the way, here are the returns. The S&P 500 in 2018, the non-dividend payers earned 28%. The high dividend payers earned 1.1. 28.3 versus 1.1. In 2019, the non-dividend payers earned 33.6. The high dividend payers earned 24.2. And last year, the non-dividend payers lost 2.4, and the high dividend payers lost 5.9.
Pretty impressive.
Oh, I'm sorry. I got I gave you the wrong years. I think the numbers are right, but when I was drawing up this table, I put the years wrong. So it's probably last year. Let me just check that. Yeah. So the first year I gave you with up 28.3, that was 2020. So last year, the non-dividend payers were up 28.3. The high dividend payers were up 1.1. 2019, the numbers I gave you were right. It was 33.6 for the non and 24.2 for the high. And 2018 was minus 2.4 for the non and minus 5.9 for the dividend, high dividend. And by the way, the non-dividend payers in the S&P 500 also all 3 years outperformed the dividend payers. So if you focus on dividends, there's no logic to it. It makes no sense. It's not income either. And the problem is, what happens is when we get these very low interest rates, people start to substitute dividend-paying stocks for safe bonds. And then the risk shows up and those dividend-paying stocks drop 30, 40%. And now you've exceeded your risk tolerance. Your whole portfolio blows up and you could end up eating cat food. That's a huge mistake. Dividends are not income. They're not even cash flow, or they can give you cash, but it's the same cash flow you can create with a self-dividend.